In this video, I want to address 4 common option trading myths or misunderstandings that I often hear about. Get my free course where I show how I generated income using covered calls. Just visit my website, coveredcallincomegeneration.com. Here's the first viewer comment that I want to address. Someone had said option contracts can only be exercised on the expiration date. This is not true. An option can be exercised at any time on or before the expiration date. In this particular case, a seller sold a 1-month covered call option, and there was 1 week left before expiration, and all of a sudden they were notified that their shares were assigned to the buyer. And so the seller ended up contacting me, asking me if I understood what happened, or maybe it was just the brokerage made a mistake. Well, it wasn't a mistake. What happened was perfectly legal and can occur with any option contract. So if the terms and conditions of the option contract are met for exercising, then the buyer has the right to exercise the option whenever they want during the valid time frame of the contract. So after an option contract gets filled, it may be exercised at any point in time during the lifetime of the contract, and the expiration date merely signifies the last valid day of the contract. So this myth is busted. I've received a lot of comments and emails from viewers telling me that trading options is extremely risky because I'm exposing myself to an infinite loss, and that I should be more responsible and warn my viewers that they could lose it all if they decide to do what I'm doing. Before I get started on this one, let me make a quick definition. Now, these viewers making the comments and sending me emails, I think when they mention infinite loss, what they're describing is unlimited risk. And the point that they're trying to make is that there's potential for unlimited losses on the trades that I'm making. So in actuality, selling covered calls and selling cash secure puts does have risk, but it's capped or limited to the total amount of funds that I have invested in the option trade. There's nothing unlimited, or there's no possibility of an infinite loss. So my maximum loss could become a reality if the company associated with the underlying shares of the option contract were to go completely bankrupt and the share value would need to drop to zero. This is one reason why when I pick a stock to use for selling a cash secure put, I want to pick a company with good fundamentals and a high potential for future growth. So this myth of infinite loss or unlimited risk is busted. The next one that I often hear is that it takes a large account in order to trade options. So one of my first responses is, well, what are you calling a large account? Now I'll get back a variety of different answers, but on average, it seems like a large account seems to be something in the neighborhood of $100,000. Now I'll be the first one to admit that $100,000 is a significant amount, but that's not what's needed in order to trade options. In fact, I've had followers and students trade with accounts as small as $10,000, $2,000, $5,000, $25,000, even $1,500. And if you visit the other videos on my YouTube channel, you'll find a video where I successfully demonstrate option trading using a small account with only $500. And my latest small account challenge consists of a series of 3 videos using an account with only $1,000. But I will admit that the larger account that you have means there is a higher potential to make even more money. But simply saying that you need a large account in order to trade options, that myth is busted. I often get comments and questions about this next myth, and it's that sellers lose all of their money when the option contract expires worthless. And I think this misunderstanding comes about because they hear or see the word worthless, and so they automatically assume the worst case. And in simple terms, all it really means is that the buyer is unable to exercise the option of a worthless option contract. So when an option contract expires worthless, the end result for the seller of the option contract is actually okay. Not only does the seller get to keep the collateral that they had reserved for the option contract, but the seller also gets to keep the premium payment that they received for selling the option contract in the first place. So the bottom line is a seller doesn't lose all their money when the option contract expires worthless. In fact, they actually make money on the deal. Not only do they keep the collateral they had reserved, they also keep the premium as a profit for selling the option contract in the first place. So this myth is busted. If you like the information about my stock picks, then consider joining my Patreon, where I share exclusive videos of my stock picks every week that I'm going to be using for profitable trades. I also include my research notes, stock analysis, and trading strategies for every stock I pick to watch for that week. And of course, all my videos posted on my Patreon are ad-free. There's one last thing before I end this video. Now, making profits and generating an income from option trading is a great thing, but keep in mind that all gains made from trading are considered income and are subject to applicable tax considerations. So every month, I save a portion of the profits that I earned in order to pay for my federal and state taxes. So please consult with your CPA, licensed financial advisor, and or tax preparer regarding the tax liabilities for your unique situation. If you're still watching this video, I just want to say thank you so much. I really appreciate it. And I also want to wish you good luck and lots of success with all of your trades.